Okay, quick word about the many benefits of becoming a member of the Green Star Trading Patreon. If you join our most popular tier, which is tier 2, you will get access to the public Discord with multiple channels covering dozens of subjects. You can ask me anything you like on there. There's a dedicated channel for that. You can make chart requests. You can even ask to have certain assets covered in the weekly live streams, and the weekly live streams are one of the benefits. These go on for several hours, between 3 and 5 hours, normally hosted on a Friday, but I always timestamp them so you can come back and watch them at any time you like at your leisure. You also get access to all of my educational content, including the Elliott Wave series, trading series, technical analysis series. So there's an awful lot of value here for just £10 a month. It's an absolute bargain, to be honest with you. And then if you want a little bit more than that, you can pay £15 a month. You get everything I just previously mentioned, but you also get the exclusive monthly dividend calendar and stock rating system, and the video which comes along to support that, which we recently just got posted up for our tier 3s here. As you can see, top dividend stock picks for the month January 2023, 32 stocks listed, 16 ex-dividends for the month, with the calendar and stock rating system posted here as PDFs below. We can see a recent live stream, then we can see our economic indicators monthly review, where we went over housing, permit starts, completions, Institute of Supply Management report on manufacturing, report on business, manufacturing, consumer surveys, yield curve, blah blah blah. So there's a lot of extra content I pump out for the Patreon. It's not just educational videos, which you can now access the 16 video long Elliott Wave series, but it's also monthly data that I release only to my patrons, and it's also extra support for tier 3s as well. So please consider joining. It really is excellent value. Thank you very much for listening. Now let's get back to the video. Hello everybody, and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Okay, it's time for an update on the SPY, which is our proxy for the S&P 500. We're also going to take a look at the put-to-call ratio. We're also going to take a look at the VIX, and we are also going to look at a few other interesting points that I wanted to share today. But before we do any of that, before we get into the Elliott Wave count, let's just start with some classical analysis here on the chart. So we're just going to switch off all the count for a moment, and we're going to come out to the weekly time frame and see what we can see. So if you saw my video before Christmas where I said early Christmas present, and that was intended to mean, as I explained in the video, to the shorts out there, we saw an opportunity to short because we came down, up to the trend line, down, up to the trend line, down, up to the trend line, down, up to the trend line. Okay, and we saw an entry point here for a short. Now from there I said, don't worry, if you missed your bite of the cherry, within 3 or 4 weeks time we will be coming back to this resistance line again, and you'll get another chance to short. Well, we're back at this resistance line again, and putting it simply from an Elliott Wave point of view, if this is a 3-wave correction and this is 1 and this is 2, then a move back off of this resistance line now down into another 1 and 2 of a smaller degree is one of the easiest short trades you're ever going to get, and therefore if you want to take it, I totally understand. Now, how things look technically and how things look set up from setting up a safe trade and setting up a trade with a very reasonable level of risk doesn't necessarily mean in any way that the market can't go higher and cancel all of that out. I've expressed before that I'm a little suspicious that it's just a little too easy to keep shorting this downward resistance line, and that's led me to think that maybe everyone's getting a little too bearish off of the back of a little too, an idea that's making them a little too complacent. And we had an event in the PCC a couple of weeks ago where we saw extremes which haven't been seen in the bearish options bets since the GFC. Okay, so traders got uber bearish, right? And this is also coupled with economic sentiment having reached extreme lows. So if we look at like the University of Michigan's Consumer Survey Index, which I look at every month for my patrons, amongst with a whole bunch of other economic indicators, we saw extreme lows in June, okay, here, and we saw extreme lows in November, right, or late October, November here. Then we saw small improvements, okay, and we saw rallies here in the market. Now we reached levels that we haven't reached before in the last 50 years in terms of consumer sentiment, and we've reached levels that we haven't seen in terms of bearish options bets since the GFC. And what that's just getting the hairs up on my back of the neck, that's all I mean, is it's making me a little contrarian. The contrarian senses juices are flowing. It's saying, look, everyone's so goddamn bearish. Can it be bearish? Yeah, it can. Of course it can. And we can all be right. Okay, and it's about to roll over again. And like I said, technically, a sound trade setup. But it's just a little too easy. And I'm still a little suspicious. So forgive me if you think I'm being too paranoid. Maybe I've gotten too old, too cynical, too paranoid. But it's just leading me to believe that it's just a little too easy. So part of me, emotionally, I'm expecting this to pop higher. Alright? But I don't trade off of emotions, I trade off of technical setups, and the technical setup says to short it from here if we get a further move down and back. And I will do that again and add to the position, but my gut's telling me there's something wrong. Okay, that there's just something that doesn't quite fit this scene. So time will tell. We'll set things up as we should. I would recommend everybody always minimise risk and go with whatever the market's telling them. Don't fight it. We've got lower lows, lower highs. We're still in a downward trend. So we don't trade off emotion, but we have to acknowledge what we're feeling, I think, and what we're thinking, and it's just making me a little suspicious. So anyway, getting back to the point, we've come to this downward resistance line. We've come to the 50% retracement of this rally from March 2020 up until the January 22 high. Retreated 50% into October 22. This also coincides with the 250 exponential weekly moving average, the green line here. And we can see how the 60 exponential moving average has been support, and it has also been resistance, and now we've got some confluence between the downward sloping trend and that 60 weekly moving average. So we've come back 50 to a major moving average. We've rallied, we've yet to make a lower low. We've come back to resistance. That's essentially the picture. From the weekly time frame, on the weekly time frame here, looking at the indicators, we had very strong bullish divergence on the MACD. We've seen a swing high in the signal here above this high, so we've got divergence again. We've got higher highs with the signal line here and divergent lows between these two lows here. So we've got lower highs, lower lows, higher highs here, and it's pretty impressive momentum here in the histogram. And this recent sell-off has failed to tip the signal line over, okay, through the average, and we've got a little green bar here, bright green bar on the histogram as well. We've also got the same divergence on the lows here, higher lows on the RSI, and we had lower lows in price. We come down to the daily time frame for a moment and leave these indicators up. If we look at the OBV for a minute, we can see that the trend in volume, the cumulative trend over time, is flat out bearish. It's just a downward trend, right? Bing, ping, 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 right? So if we do break any significant level in the in terms of price, we're going to want to see confirmation in the volume, in the on-balance volume here. So essentially we've got a pivot here and we've got a pivot here. This is the major pivot that's going to undo a lot of the bearish interpretations back here, and we'll talk about that with the Elliott wave count later. So a move back out of that trend in the OBV, a break of these levels here, right, and you're looking at a potential bottom being in place, or the likelihood of a bottom having in place greatly increases at that point. So there is a bullish count to be had, okay, off of this pivot here, right, to move higher. This may even be a free wave head fake, right? If this is 1, this could be A, B, C into 2, trap all the bears off of that resistance and then reverse higher. For as long as this downward trend is in play, there are multiple options in play, which could hurt people on either side if they're not managing risk properly. So there you go. But yeah, I'd want to see that downward trend in the volume, in the unbalanced volume break. Now, on the weekly time frame, just coming back to the actual volume for a moment, we can see how we had declining volume through this correction. Okay, and then we've had increasing volume in this move off of that low, with a little push from volume on this bar here, candle here, weekly candle. So this move is supported by volume from this low. Okay, it has strengthened as it's gone higher. Okay, it's not blowout volume, but it's strength. and we saw there's momentum here as well. So a break of this level and a break of this trend cannot be ignored, okay, or taken for granted necessarily, because we don't trade breakouts. I've mentioned this before. You know, I'm just saying to prepare for the possibility of it. So that's essentially how I see things on the classical analysis point of view. Now there's a couple of things I want to share with you here. So let's just head over to the PCC. Now this might be slightly out of sequence, I know, but I think it's more important to do this now than it is to do it during the Elliott wave segment of the video, which we'll finish with. So I use the 60 and 250 exponential moving average here to smooth out all the noise. I will switch between as low as a 2-day, 5-day, 10-day as well, just to see the volatility here in the PCC, but this is what I do to smooth it out over the very long time. We've come to a new high on the 60 exponential moving average here, still above the 250, and we set a higher high, and we broke a long-term downward sloping trend as well, which we can see here. So this is a new extreme. Now it's so extreme that the 60, obviously lagging from from having come from so low down here, has not really shown you just how extreme a move this is. If we were to shift this down to a 10-day or even 5-day moving average, you would see it. But the easiest way is to just show you the actual price itself. There's the peak in the 10. So if I were to just come back and show you a horizontal line from where that peak is, you can see it matches some pretty extreme levels we've had before. But if we actually just run the data for the moment, okay, here's the actual peak on the line chart, 1.947. The intraday candle came to 2.123. We can see quite clearly from that level, if we get our horizontal, nothing has been as bearish a bet in the put to call ratio in the options market has been as bearish a bet since the breakdown in the GFC. Okay, so this is extreme bearishness. Extreme bearishness. Now let me just show you where that extreme bearishness occurs on the chart, because I find it I find it quite fascinating. Right, so let's just switch that off and come back. So we've got the 28th of December 2022. Let's come to the SPY, let's come to the daily, and let's find that daily close on the Wednesday 28th of December. So we get vertical 14, 15, 16, 17, 22nd, 23rd, 28th. There it is. So there's the daily close, solid bar candle. It's below everything at this bottom. So the first swing off of the low and swing back to a lower low actually got everyone into full-on bearish mode. Super bearish. Right, on that exact day. So that's normally a contrarian signal. When the bearish bets get this extreme, that's a low. And sure enough, it was an exact low. However, does that mean that that's actually confirmation that this was when the market bottomed? We've moved up to resistance, everyone gets bearish as fuck into here, and then it reverses and goes higher. That would be absolutely typical for that to happen. Okay, now I know this is like, oh well, this is all classical analysis, is not that Elliott wave, and I say absolutely I love Elliott wave, you know I do, and I trade off of it. However, I'm just pointing out some things of interest here. So an extreme reading in the PCC that we haven't seen for well over a decade occurs on the exact low on the chart here, not the intraday low, the close. Okay, and that's when the options reach their most extreme. Now something else I've noticed, we're just going to come out and have a look at something else for a moment. So we're just going to come over and have a look at this little chart. Now this is from the University of Michigan Consumer Survey Index. Now I come across every month for my patrons I do a leading indicators and economic indicators video, and one of the things we look at is consumer sentiment from the University of Michigan. Now this is a chart going back 50 years, and we can see that the most extreme readings we have seen on the chart are 1979, 2007, 2008 and 2009 down here, 2008, 2009. Here's 7 really. 2008, 2009. This is the grey bars of the major recessions, right? We get the 2020 hiccup with this low here, teeny tiny short-term recession. And then we get extremes that we haven't seen in the 50-year history, essentially, going all the way back. So this is now 2022, and this is June and November of 2022. Now these lows, the GFC 79, 75, 91, 2022 maybe, these lows represent lows in the market, right? Here's late 2012, 13 here. So let's just come over and have a quick look at the chart. And I just want to load up the SPX for a moment, because I've just looking at everything since the GFC. Okay, let's come back. I've got a bunch of bars here which show you a little interesting divergence which occurred on those two extreme readings. Let's put the chart into log. So we got an extreme reading in June, and then a slightly improved reading diverging from what the market was doing into lower lows in October, between these two lows here. And these were extreme readings in the consumer sentiment. Okay, now at the same time, or I should say in the same way, excuse me, back in the GFC we had the same divergence between lows occur and extreme readings in consumer sentiment as well, reaching their absolute lows back here. See this little move? Bump, bump. You would be able to see it, but it was so much more vicious because obviously we've been through such an incredibly, extremely violent and aggressive rate rising cycle that I think we just haven't had time to actually get enough small data on the chart. But you can download, if you want to, from the site. You can download an Excel sheet of giving you all of the recorded consumer sentiment. You can look at it by date, look at it by the actual record. And I've done that just to double check my work here rather than just looking at this chart. But either way, you take my point. Extreme lows in the GFC with that little divergence in place. Extreme lows in 2022 with that little divergence in place. And I've pointed out a couple of other areas as well in the past, like the extreme low of 1974. Okay, this is another huge bear market. These lows are marked by extreme lows in consumer sentiment. We have extreme lows in consumer sentiment marking the lows here at the moment. We don't know if they are the lows. I don't know if it's the bottom, but we have an extremely bearish consumer sentiment marking these lows. We have extremely bearish options sentiment marking this low. It all seems just a little too bloody bearish. Okay, now maybe it's because the world's about to end and the market's about to completely implode, and like I said, short side setup from a technical perspective makes the most sense. But I just wanted to put that evidence forward just in case there are some other people out there who are a little bit instinctively contrarian like myself and are just finding it a little too perfect for the bears at the moment. But there you go. So I just wanted to share that. You might find that interesting. If the idea of looking into those monthly economic indicators, I look at housing starts, building permits, completions, I look at business inventories, manufacturing inventories, I look at production, I look at retail earnings, manufacturing earnings, and I look at the ISM as well, and I look at the consumer survey. I look at all these things. I do it once a month in a video, and I put that out on the Patreon. So if you're interested in that kind of thing, there's a link in the description of this video. Head over and sign up now at tier 2 or tier 3, and you'll get access to those monthly videos. Right then, so that concludes the classical analysis part. I think we've covered everything we wanted to cover. So now let's come in and have a look at the Elliott wave count. Okay, so bearish count first. Let's just come down to the 4 hour here. Alright, so I've got this as a zigzag, flat X, zigzag, zigzag, and then a final zigzag lower. Essentially the whole thing's getting bigger and more bearish over time. So double zigzag, 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 like that. There is an option which is even more bearish, but it has serious issues with the subdivision, but it's still possible. So we'll talk about that as well. But either way, for the moment, I see this as, you could see this as a double zigzag, or you can count it as a single zigzag ABC, breaking this support trend, breaking this move up. We had divergence at the highs here in our indicators, and then we rolled over. But this is what my video before Christmas was about, how, you know, we've come back to the downward trend again. We've broken through it. We've gone 1, 2, obvious short back to the trend line. Okay, perfect resistance here. Down, back, boom. That's huge short signal, and off we go. Down. But like I said, don't worry, we'll be on our way back, because every one here is followed by a 2. We're back at the trend line again. We're back at the 60-18 to 65 golden ratio here, the golden zone. Golden zone at the resistance line, at the 60 exponential weekly moving average. We have every reason to sell off again, correct? Okay. Now we don't just short it from here, obviously. We look for what we got here. We look for that again. Once again, a lower high, a swing low which breaks this trend, and then a move back to a lower high, and that's your entry point. That's your stop, and off we go, safe as houses, right? Easy peasy. So that's what we're going to be looking for now, and that's the bearish count. We've got 1 and 2, we've got 3, 4, 5 to come to finish the C wave. This is the B, this is the A. We've got the C to come, and we're going to go lower. And all the bears in the options market, and all the bears in the real economy, and the average consumer sentiment, and the generally bearish sentiment I feel is out there at the moment is correct. They've got it right, and we're going to go lower, and we're going to ride it down with them, and we'll all be enjoying the short on the way down here together. Okay, and that's how it works out for the bears. So, fair enough. Now, let's just look at an alternate interpretation for the bearish count. This could wreck a few people, but I think it's very low probability because of the scale is starting to get deeply skewed. If this is 5 up instead into an A, right, this could be 3 back into a B, and then it could be another 5 up into a C for another zigzag into a B, right, and then 5 waves down in the C. I find that very unlikely to be at the same wave degree, purely because this B wave is so gigantic relative to this A wave, and the overall correction in the Z of our WYXZ is now so massive relative to the prior zigzags. I know they're getting bigger, but that seems a little too much. So I think that's pretty low probability. So I would definitely side with the more out of the bearish counts. I would definitely side with this first interpretation that we've gone A, B, C into B within Z, and now we've got 1, 2 done. We're going to go 3, 4 and 5 down to new lows, and that will be the bottom of the market when it comes. We'll have to see if we make all even lower lows in consumer sentiment, but you know, with CPI cooling off, I've been saying for months and months that I feel inflation is going to go away, and once it does, and we realise the damage we've done, we've been looking at those leading indicators slowing down month after month. When the damage arrives, and we get fearful of not getting a soft landing, no certainty in that, but that could be the case. I think we could be back to easing monetary policy quite quickly, as in months. I'm not saying like tomorrow. Be patient. But you take my point. It's the market's forward looking. It's anticipating things long before they occur. So maybe CPI cooling off, anticipating future easing monetary policy is all we need to just rally the hell out of here. So on that note, let's have a look at the bullish interpretation. Right. So we're going to move this, leave this 2 here. That should have been down there for the bearish count, sorry. We're going to leave it here. So the bullish count says that the count's already concluded. Okay, and we get that by, instead of this being a 5, it's itself a double zigzag. 5-way swings, it looks like an impulse, but there's no alternation between corrections, and it seems to subdivide as, you know, 5 3 5 3 5, but 2 zigzags connected. So coming off of the low, it's a little tricky because there's 2 ways of interpreting how we get off of the low, essentially, but or where we'll go to from this point. 1, 2, 3, 4, 5. Okay. Now this invalidation point was for this first 1 and 2, so we don't need that anymore. So it's been a little while since I've updated it, see? So we'll get this out of the way. Don't need that. So we've gone 1, 2. Excuse me, I'm just doodling on the chart again. 1, 2, 3, 4, 5 into here. This gives us 1 at minute degree. Now I'm not sure where that's gone. I'll just throw that in. 1, 2. 3, 4, 5 up here. Right. Now what I see this as potentially is as a flat. 3 down, 3 back, and 1, 2, 3, 4, 5 into a C, giving us a 2. This is proving very tricky. Alright. It's not beautiful from a bearish perspective either. Looking at it as a zigzag doesn't look very nice. Looking as it does, double zigzag doesn't look very nice. So, it could be, in the most bullish interpretation, an extension. Building up where we have 1, 2, 1, 2, 1, 2, 3, 4, 3, 4, 5, 3, 4, 5, 3, 4, 5, like that. We start to expand higher. Now, if that's the case, then this was a bottom back here. This was the bottom of the 2 where the options got extremely bearish and we're already off in a 3 at minute degree. Right, now if that's the case, we will eventually complete 5 waves up. So let's just get a little forward looking for the moment, just in case. So off of this swing here, 3 could be expected to complete up here at 474.69. So basically the previous all-time high, coming into a big double top, keeping things ambiguous because obviously you'd have 3 ways back by that point. So you could, you see what I'm saying? How you could easily interpret this as 3, that is 3, this will be 5 down in a large flat. But if this is bullish and this was the bottom, that would actually only be a 3. 4 would come, 5 would take us to new highs, okay, and then that would be 1, and then you'd be coming down in 2, off into a couple of years, a year or 2, I don't know. Throughout the rest of this year at least, I would have thought to complete these 5 waves up, or most of it. So that's what we could be unlocking here. You never know. Either way, we have to break this high. We have to break this trend. We have to continue this accelerated move higher. We have to take out these pivots. And the one pivot we're really looking at taking out is this one. Let's just put this in the correct folder for the moment. I hope you're following this, guys. It's honestly way more simple than it looks sometimes. Here's the major pivot at 431.73. Now that's the major pivot because the interpretation of that being 5 down and this being 3 to here, or even 3 to here, and then a continued move down which matches this one, so we get an ABC. Okay, that's completely cancelled out here at 431.73. Any other count at that point has to be basically rethought in terms of you being bearish, because any continuation of this downward trend is definitely broken. You'd have to have some kind of different swing. You'd have to be looking at something like 3 to here, 3 to here off of a 5. You'd be really backing a flat at that point, being bearish. If you broke that pivot, you'd be relying on coming way back up high. I think it'd be very difficult. You could maybe argue for a double zigzag, where you've had a zigzag down to here, a flat up to here, and then a zigzag down again. But you are definitely fighting probability at that point. You are choosing more ambiguous counts over simpler ones. You could still be right, but you are definitely choosing more loosey-goosey counts which have a lot of work to be proven yet at that point. But take out this pivot in the short term and this low starts to look very, very bullish. Okay, so that keeps that nice and simple. One other way of looking at the bullish count as well is this could still be 1, but this could be A, B and C. Okay, so we could get that rejection. So that's 2 votes now to vote short in the meantime. Right, I'm not going to argue with the market. Downward trend, lower lows, lower highs, back to resistance, potential ABC in a bullish count, potential 1-2 in a bearish count. That's 2 to 1 saying that we are going down. All we need to see is a move down that breaks this current trend and a move back, and we're all for it. Right, off we go short. That's all we need to see. I'm just laying out the alternatives. So there you go, guys. That's how I see it. So to sum up, let's try and sum up as clearly as we can. Easier said than done with the way I waffle on. Bearish option number 1. We've got an A, B, C down. We've done the 1. We've done the 2. All we're doing now is looking for confirmation to move lower to short. Right. That's the most popular bearish count. Bullish count. We've gone 1, into 2 as a flat, and now we're extending, in which case tough luck for the bulls, because this was the last real buying opportunity you got. If you didn't load up on the lows here or off of this 2 here, then this could get very explosive very quickly, and you're down to trading shorter time frame, okay, until you get the 3, 4, 5, 1 into 2 back here, and that could be months and months away. But it could run crazy potentially if that's correct. It could go absolutely mental, at least for a few weeks or maybe a few months. More likely a few months. Alternatively, that's 1, and we get A, B, C, right? Which doesn't take out the invalidation point at 348 spot 11. Now that's ideal. In many ways that's ideal, because what that does is it gives everybody on the short side an opportunity who's flexibly minded, and everyone on the long side an opportunity as well, because what it does is it gives us 1, 2 off of here and a C for the short, which we're expecting 1, 2 into 3. We can protect ourselves from this lower pivot, move down to here, and if we see a reversal off a positive divergence that brings us back up, breaking the downward trend into 1 into 2 to the upside, we can go long. And then we're back at the trend again, aren't we? You see what I'm saying? So it's all a case of just being flexible enough to just play with these levels, because it's all there for you to do. So that's the way I see it. It's either 1 into 2, off into 3 in an extension, or this is A, B, C into 2, and then off into a 3 opportunity to long, or it's bearish, which I think it looks better, without a doubt, from a technical point of view. It looks better. It's A, B, 1, 2, here we go, down 3, 4, 5. And that's the way I see it, guys. So let's now come back and have a look at the VIX to finish off. We really won't take too long here. We've already covered the PCC, breaking that new level, getting that extreme reading. That's the only thing I really wanted to cover in it this week. Now the VIX, it just is not impressed with this bear market at all when it comes to just how scared and panicked and worried and bearish everyone should be. It just doesn't care. Volatility is coming down. We can see in the downward sloping resistance line here. All right, we've got this upward rising line here. We're getting into this big squeezy kind of structure. We're heading back to that support line. We've got time in the market still to fuck around and then come back to here, breaking those pivots and then getting another spout of volatility. Will it break this trend line, or will it just come down again and continue to consolidate? The only thing which is going to really prick up my ears and make me pay attention is taking out these highs relative to what we're doing in price in the SPY. Obviously it's all relative to what the price is doing, but taking out these highs, I would see another move down to support and a spike up to here as supporting the bearish case completely, right? And then we want to see lower lows in price. However, if we break this long-term support and come back to readings we haven't seen in quite some time, you know, and we break this long-term uptrend since 2017, that's going to look an awful lot like a very good reason for the market to just go crazy higher and just race off. So there you go. There haven't been many opportunities where the opportunity to set up a trade between pivots has been so well supported by a downward trend. So I think, once again, I'm going to say it again. I know I keep repeating myself, and I'm sorry if you're getting bored of me saying it. From a technical point of view, from an Elliott way point of view, it says short me. But it just makes me a little suspicious, is all. So I'm going to wrap it up there, because otherwise I'm going to be here all day repeating myself. And so thank you very much for joining me. If you're new to the channel, you like what you're seeing, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. As always, a huge thank you to my Patreon subscribers. Your support is massively appreciated. If you're interested in joining the Patreon, there's a link in the description box below. Head over and feel free to sign up. We'll be glad to have you. Take care of yourselves, guys. I'll be back with you with a Bitcoin update later in the week. All the best. Bye bye.